Welcome back, everyone. So, we had the primary elections held on Sunday of this past week, and it seems to be that Javier Milei won, or got the largest percentage of votes, which was quite the shock to the markets. And this week we're going to discuss the implications, what it might mean, what to expect, and so on and so forth. So you can see this candlestick with very long tails or wicks on both ends. And come Monday, YPF, which is the primary stock and ADR that I'm focused on in regards to Argentina, opened about 2 or 3% down, and then it went roughly 7 to 8% down, and then it bounced back to being about 7% or 8% above for the day, to then retrace and give that up and practically close out where it started up. And then throughout the week, it's muddled along and slightly up from Monday's open. That's what you call volatility. Essentially a 14% intraday swing. And many of the other stocks experienced similar volatility. And I would say you probably shouldn't expect anything less. The interesting thing about volatility is people use it with a negative connotation in regards to the downside, but volatility also gives you upside. And you can have a lot of volatility over weeks and months of period, and the stocks still go nowhere. Just look at the S&P from April of 2021 to April of 2023. There was lots of volatility, but the stock went nowhere, or the market went nowhere. So what are some things that have developed over the past week? Well, Argentina raises interest rates, devalues peso after shocked primary election. Argentina's central bank will raise the benchmark interest rate to 118% from 97% previously, an official source said Monday, adding the country's currency will be devalued to 350 pesos per dollar in the aftermath of a shock primary election. As I said earlier last week, I think Patricia Bullrich is a good happy medium, and she came in second, which is good. But Milei won it, and you don't necessarily want someone too radical because markets don't know how to handle it, at least in the short to interim. It goes on to say, Sunday's primary vote, seen as a reliable bellwether for the upcoming presidential elections, propelled ultra-right libertarian outsider Javier Milei, who wants to axe the central bank and dollarize the economy, to first place with some 30% of the vote. The official peso plunged nearly 18% on Monday morning to just over 350 pesos per dollar, and the source said the exchange would be fixed at this rate until the October presidential vote. Latin America's third biggest economy is battling a severe economic crisis with sky-high inflation and dwindling central bank reserves. Now, there's something you have to know when it comes to Latin America, and especially Argentina, as well as just general countries and election cycles, because you can make or lose a lot of money due to the high volatility of election cycles. It's an event-driven trade. But don't get caught up in the evergreen stories that you're told. Like, oh no, they've devalued the currency, they raised rates. It's nothing new. It's the same old, same old. The comment I made last week about the consensus of Argentina is that every 10 years they have a 10-year crisis, which is to essentially say that they're always in crisis. And here we are, the Argentine peso is down 90% in 5 years, and it's down 50% year to date, factoring in this 18% devaluation that's happened in the prior week. Another same old, same old. Argentina announces new price caps in a bid to contain runaway inflation. With the intention of anticipating the impact that the exchange rate devaluation may have on inflation, the Argentine government has announced a renewal of the price agreements already in force with increases of 5% per month for 3 months. The government expects that after extending the 600 price agreements already in force, companies will roll back the price increases already made between Monday and Tuesday. We are aware of the variation of the US dollar, and that is why we launched tax relief mechanisms for companies so they do not pass on the increases in the exchange rate to products. Now think about that. This is the problem with positive feedback loops and reflexive deterioration. So they're going to reduce the government revenue, which is the same as saying that they're going to give tax relief to companies, which means that those companies will pay less taxes, which means that the government collects less revenue, in order for the consumer to not pay as much, which means that the consumer will therefore use more. Just like you saw with them raising the interest rate to 118%. Notice they didn't really raise it too far above the current inflation rate, which, depending on where you look, is 113% or 118% or 120%. They just match it. Well, matching inflation with interest normally is not enough to subdue the inflation. It's a constant game of keep up, but it doesn't actually resolve anything. It doesn't fix the problem. It just ostensibly makes it look like you're doing something, because to do something would be a good way to not get elected again. Anyway, the announcement comes after the country's central bank announced on Monday it would increase the official exchange rate by 22% in order to contain the impact that the devaluation may have on prices in the coming months and in the run-up to the general elections on October 22nd. Yet again, it's nothing new. It's an evergreen story that tricks novice investors into thinking this time is different. That's the disclaimer I made on the video last week, is this is an event-driven trade. And I'm risking losing a lot on this trade in order to not get stopped out of the trade. And this trade has already made hundreds of percent, and I'm late to the party, which is to say that I'm chasing. You could say it's FOMO, but yeah, fair enough. But this is not a new story. This is a headline article. Argentina enforces fuel price caps despite warnings of oil production slowdown. This is from August 16th of 2019. 4 years ago. You see these evergreen stories where new investors come in and try to participate in a market when it's the same old pipe dream. It's the same old trickery, so to speak. You see this with value stocks. Someone buys a deep value stock that's really just a value trap, and then they get beat up in it, or the stock goes nowhere for years, and they finally dump their positions, and then a new generation of traders come along, see the stock, believe the same things, and it just rinses and repeats. But that doesn't mean that money can't be made in the interim based upon volatility. Here's an interesting thing to note. The Merval index, which is Argentina's stock market, is up 183% year to date. And there's a lot of parallels that one could draw between here and Turkey. And the problem, or maybe not a problem with Turkey, was Erdogan stayed. There was a lot of volatility. But what you see in these markets, when the currency is devalued, is people go to the market to preserve purchasing power. The problem is that purchasing power is still in the currency that's getting debased. At some point, you have to trade currency, and that's a struggle, but it at least preserves the currency until they wipe out the currency altogether and come up with a new currency, and then you go to zero. And that's what happened in Germany, for instance. So it's a good game to play till it's not, which is one reason why you see the Istanbul, Turkey's exchange and index, up so much over the prior years. And that's why you see the Merval up so much. Just look at I can't remember Bolsonaro, no, the Venezuela's index, the Caracas, that's what it is. Look at that index. That thing has gone parabolic. So you need to keep these things in mind. And then even if you could participate in the market through the country's actual exchange, when you go to repatriate the money back to your country and exchange it for dollars, you didn't really get a hit in life. So why is Milei theoretically bullish for oil, as well as lithium, but we're not going to get into lithium. So this goes on to say, while Milei's campaign manifesto is heavily skewed to farming, it also mentions promoting investments in oil and lithium. But by minimizing state involvement, his approach would upend how Argentina has already been going about that. Milei, who won by a landslide in oil heartland province, would move to re-privatize state-run driller YPF, which has spearheaded development of the Vaca Muerta shale patch since being nationalized in 2012. To spur shale drilling, he'd instead boost competition between domestic refiners and international crude buyers by knocking down export hurdles and uncapping Argentine fuel prices, which would be bullish for YPF because instead of having to sell oil in Argentine peso denominated currency at a cap rate price, they would instead be able to sell oil for US dollars at global market values. So that's a double win. And that's why it would be bullish for the oil producers of Argentina. So, why is market-friendly candidate Javier Milei spooking investors in Argentina? This is kind of the summary. And things to take into consideration and factor. Because you might ask, well, Milei won, that's bullish for markets. Why is the market having 14% intraday moves and trading flat for the past couple of months, practically speaking? And here are some reasons, things to take into consideration. One of the key factors that could explain markets' current sense of unease is the general uncertainty regarding the final outcome of the general elections in October. While Milei achieved an excellent result, the election ends up being divided into three parts. Nothing is certain for October. With a three-horse race still on the cards, every statement from candidates will create noise and volatility, and the point where all this uncertainty and volatility will naturally converge is in the currency market, he added. Referred to the steep devaluation of the peso yesterday and surging parallel exchange rates. The Argentine market, which has witnessed sharp fluctuations in the recent past, is factoring in that Milei's victory has added an extra dose of volatility, as his pole position was not previously considered a likely scenario. Well, that's an understatement. Regardless of yesterday's result, he mustered less than 2 points more than other people and 3 points ahead of others, leaving an extremely competitive scenario leading up to the general elections in October. Second reason, governance. This should be an interesting one. Despite being a market-friendly candidate, Milei would face significant challenges in implementing the radical reforms he proposes for the Argentine economy, considering that his eventual minority in Congress would imply a complex political and legislative outlook. The market is indeed questioning the potential governance of a hypothetical government led by the libertarian candidate. I have a feeling that we are going into a scenario that is good for Argentine assets in the long run, as about 65% of the electorate has said no to populism. In the short term, due to the three forces being very close, it means extreme levels of noise and volatility. He added it in the same vein, highlighted that the market is not only assessing each candidate's proposals, but also their ability to carry them out should they win the presidency, right? It doesn't matter what you say, it matters what you can do. And if Congress is going to block much of what you can do, then what you say shouldn't be expected, therefore the market will price it differently. Like that's just how things work. That's how reality works. That's how we as humans work. His lack of experience and absence of robust political structure are leading investors to doubt Milei's capacity to execute his government plan, which includes complete economic dollarization and the elimination of the central bank. All I have to say to that is good luck. Immediate impact on the markets. The immediate impact on markets has been negative. The full dollarization that Milei proposes, the uncertainty regarding the feasibility of his economic plan in general, and about the election results in October have led to sharp declines in asset prices. An economic consultancy pointed out that in the short term, uncertainty will drive investors to seek coverage in order to protect themselves from the unknown. The central bank has intervened to contain the parallel dollar by selling future contracts and raising interest rates, he said. For bonds, in principle, this is bearish due to the uncertainty and the market sense of surprise. The market needs to digest this. Today, Monday, which was 7 days ago, we would expect bonds and stocks to fall. Bonds could drop between 5 and 10%, but it's nowhere near what happened after the primaries in 2019. Final slide here. The optimistic view. Despite the initial fear, the economist sees the possibility of a more positive medium and long-term perspective for assets, pointing out that Milei's victory could increase the chance of a strong fiscal adjustment, lower taxes, and reduce public spending from 2024 onwards. If the libertarian candidate manages to implement at least part of his plan, it could lead to an increase in bond values, with the potential for Argentina to return to the global credit markets, which would be nice, by the way, because then they could actually, have credit at a reasonable price if they could actually improve matters. Ultimately, the inherent uncertainty of radical political change is what has instilled fear in the Argentine market. While Milei's pro-market proposals might be appealing to some, questions about his ability to implement them and short-term volatility are keeping investors on edge as they wait to see how this new chapter in Argentine politics unfolds. All right, so there you have it. Another thing I'd like to note about markets is that you have different level traders, and they trade different parts of a secular theme in a market. And what I mean by that, I should have put an image on this, but you have what's called the Lysandra curve. So in mining, you have those who will bet on an exploration project's success. And then if they get success, then the stock goes up a lot, let's say. Assuming it's not buy the rumor, sell the news. The stock goes up a lot. Those people sell out. Okay? Then the next group of investors come along who then are betting on the pre-feasibility study and permitting and zoning and social implications and all that stuff. So they bet on that. And then if that all clears, then they get out. Then you have, not to belabor this point, but then when everybody says, okay, we're making a mine, we're going to start building a mine to extract resources in the next few years, the stock often drops. And then a new set of investors come in, those who are betting on either the mine being bought out or that mine going into production, because each one of these sequences takes on different risks and have different asymmetrical opportunities. So there's production risk, takeoff agreements, commodity price risk, and so on and so forth. And so each one of these stages has a different style of investors. So just like Argentina, you had the speculators who were speculating, call it a year ago, that there might be an election upset for the embedded Peronists, and so therefore they bet on it. And then they're now perhaps exiting the market with the primary elections coming up. With the primary elections now being done. And some of them probably sold out before. They made enough money, they got out. Then some people waited for confirmation, and then they got out or they added to their position, which is why you see a 14% intraday move. Okay, then the primary, then you'll have the actual election, and then you'll have a new set of investors come in or come out, short it, go long it, express their ideas differently. So you need to understand that also contributes to volatility in markets. when there's these progressive sequential stages of development that answer unanswered questions, if you will, and make something more or less certain, like I would say it's more certain now that some form of a conservative government is going to come to power than not. Then the question is how right-winged, how conservative, how libertarian, whatever word you want to use is the question. And then you place your bets accordingly. And that's another phenomenon going in on the markets. That's part of the systemic structure of markets. Placing your bets dependent upon certainty and risk-reward profiles. So, with that said, market review. I'm sorry, not market review, portfolio review. So, last month was a good month for me. I think I was up 9% roughly. This month, the first week I was down, second week I was up, third week I'm down, and the S&P is down probably 5% from its recent high. So my names are retracing. LPX, Louisiana Pacific, has been a disaster, which is why I really can't confidently position size it to anything meaningful at this point, because it's just range bound. Builders First Source broke out months ago, ran hard. Many of the home builders broke out, ran hard. Even Boise Cascade broke out and ran relatively hard in relation to Blue Links or Louisiana Pacific. And Louisiana Pacific, I was up 40%. Now I'm up 4%. And I wouldn't be surprised if it just trades in a range. And it's either going to break down or break out. And that's a problem for months in advance, me, I suspect, of whether I'll add to it if it breaks down, or if it breaks out, then I probably will not buy it. Right now I'm sitting at 31% cash. I'm trying to position myself accordingly to my expectations in upcoming months. Now, you will notice that with YPF, last week I had 4 shares. Now I have 7. What happened? Well, Monday, I bought the open, and then I also bought, and then I added more on the dip. On the way down, the first couple of hours when the markets opened. And as a consequence, I lowered my cost basis, and I'm slightly up on the position. But that's the beauty of these things. You could be up 5 or 10%, but that means nothing. There's no margin of safety for that. I mean, you can see Louisiana Pacific. I was up 40%. With Louisiana Pacific, I've been anywhere from down, call it 10%, to up 40%, and I pretty much retraced the whole win. And same thing with pretty much all these names. You can have a up 5 or 10% day. It doesn't mean anything. That's just noise and volatility. That's just, as far as I'm concerned, normal trading range. So I could be up 2+% on YPF. That could all be wiped out tomorrow, or it could double in my gains tomorrow. It's such a volatile position and name, especially with all the events-driven stuff going on around it, that it really could, I don't want to say trade anywhere, but for all intents and purposes, per se, it could trade anywhere. So, is what it is. I actually made it a larger position than I wanted to. I didn't really want it to be more than 5% of my book. It's due to me adding on the dip. I made it, I think, 6 some odd percent of my book. With inflows of cash in the next couple of weeks, it should go back to being 5% of my book. So I'm okay with the position sizing here. Is what it is. So we'll see. I expect it to be very volatile. And the funny thing about so many moves is, people talk about 5-baggers and 10-baggers, but practically any 5-bagger or 10-bagger you ever hold is going to have a 50% retracement. Now, that doesn't mean that if you have a 50% retracement, it's going to be a 5-bagger. But just know that 5-baggers generally require 50% retracements. Or not require, but seems to be the norm. So this is more of a headline-driven trade. So as I said prior, I very well could get stopped out of it if the thesis changes or if developments no longer support my thesis and expectations, and then I'll just get out of it and move on in life. If it's a 5% position and I sell it at 20% down, then it hurts my entire portfolio performance by 1%. So even though 20% down selling out of it, let's say I sell out of it 50% down, it hurts my entire performance of my book by 2.5%. So essentially I will have erased a month's worth of gains at some other point. Something like that. It's not the end of it, even though you're like, oh my God, I'm down 50%, this is horrible. And it is for that position, but for the overall portfolio, it's not. And same with the upside. Say I get out of it at 100%. Well, that's a 5% gain. So maybe that's a month or two's worth of performance to the upside. So it'll add alpha, and I don't know, it just seems like a good asymmetrical risk reward. Wish I was in the trade earlier, didn't know about it, feel like there's still opportunity, so that's why I'm in it. I've been waiting to enter into it, letting it cool down some for 2 months. I've been eyeballing it, so it's either a shit or get off the pot type moment. Either, because I've been watching it. And I tell myself at some point, like, okay, it's hit my buy point. Either stop watching it and remove it off my screens or enter the position. And sometimes I remove it off my screens and don't enter a position. International paper was one of those. I didn't do it, so I removed it. And then YPF, though, is one that I have been paying attention to, and I'm interested in the trade. So here we are. With that said, thank you for watching, and until next time.